We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always go to the website to learn more about Brian's team, if you will, at deckerretirementplanning.com. And I say this every week on the program. It's an opportunity for you, if you'd like to learn more about retirement, some of the areas of maybe people have some concern about, they'd like to know more about. You can just go to deckerretirementplanning.com under the heading of Safer Retirement Education. There are books, there are useful guides you can download, including Brian's book on retirement, the Decker Approach book. And it's just there for your information. There's no cost to do so. You can pull Brian's book right off the website. There you go. You're good to go. But it's really for your information. So you kind of do your own due diligence when it comes to your retirement planning. Brian and the team have set this up for you. There's 12 different things you can download. So it's a great opportunity for you to learn more. Then maybe you got some questions. You can always call them. No cost for that either. 833-707-3030, 833-707-3030. So Brian J., you and Arrin Wray ready to go, and you're gonna cover a lot of ground on different topics today. We're gonna end up in our final segment. Make sure to stay with us for that. We're going to talk about what happens when you do actually come in and sit down with someone from the team at Decker Retirement. How does that play out? Is it a one meeting and you're a client? Is it 3 meetings? How does it all play out? We're going to discuss that in our final segment. But first, Brian, you're going to talk about the strategies that you put in place, and they're not the exact same client to client to client at Decker Retirement because everybody's situation is unique. But how do these strategies hold up during good markets? Obviously, they should be good in that. Down markets, flat markets. So you and Arrin, ready to go, aren't you?
We are ready to go, Mark. Tons of information. First of all, I want to point out that, Arrin, there's a difference between accumulation strategies and distribution strategies. I want to cover that because in your 20s, 30s, 40s, 50s, if the markets go down 30, 40%, no big deal. You've got time on your hands. Your income's coming from your work, and in the 3 to 5 years that it takes for the markets to recover, you're putting new money in the markets every 2 weeks, so you actually benefit from that. But if you're 65 and older and your portfolio, your nest egg takes a 30, 40% hit, and you're retired, your income's coming from that portfolio that's down 30, 40, 50%, that is a game changer. And so we want to make sure that we emphasize that the strategies that get you to retirement are not the strategies that you use in retirement. Arrin, can you elaborate on that a little bit?
Yeah, absolutely. This is one of the main points that we try to help people understand in any kind of initial interaction, first meeting, first call. We really want people to understand that they've done a great job getting to where they are. A lot of our clients have worked for decades building up the assets, the income streams, all of the things that they're going to use for income in retirement. And now they need to adjust the way that they approach both the investment strategies and the investment vehicles that are used for the second phase of your financial life, when you're actually going to start spending the money and the income that you've built up. And so it's one of the things that does take a little bit of a mindset shift, because you've built great habits over the course of your working career, saving, like you said, Brian, dumping money into the 401k or other retirement accounts every month or every couple of weeks, building those assets up. And the strategies investment-wise you've used to get to where you are not going to be effective when basically 2 things have changed. Number one is that you're now actually starting to spend the money that you have in those accounts. During your working career, you don't touch the 401k, the IRA, the other retirement accounts. It's just kind of a bucket of money set aside, sitting, fluctuating with the movements of the market and growing over the years and decades that you have those funds invested. But when you retire, you are now starting to spend that money. And the second thing that has changed is that your time horizon has changed, where again, when you're 30, 40 years old, market takes a 40, 50% drop. Yeah, it probably doesn't feel great, but if you can hold the course, if you can continue to add, you look back 10, 15, 20 years later, those are the best buying opportunities that you had. You had some really good growth from the point in time that you added money in those big market downturns. Imagine yourself 75, 80 years old, and that same 30, 40, 50% market drop happens. Much different situation, much more impactful to your financial health at that point in time. And so, Brian, to your point, the strategies don't work the same way that they used to. And you want to make sure to adjust them so that you're not one of the people that the articles are written about that says, we had $1 million or $2 million, thought we were set, plenty of spending money, plenty of discretionary income. Market took a 40% hit. We didn't really have things properly invested or protected. And now you're staring at either greatly decreased income, selling your house, moving in with your kids, making some other not so fun financial decisions because you didn't adjust the strategies and the vehicles investment wise that you need to when you actually stop working. So it's one of the most important things that we help people understand is that what you've done so far is not going to work the same way in retirement. And if you continue to do that, you are leaving yourself open to some pretty big dangers, especially if there's going to be a market correction in the first few years of your retirement.
Now, we're going to peel the onion and get very specific. When we talk about a difference between accumulation and distribution, let's be very, very specific. So first of all, when it comes to a plan, instead of a pie chart where it shows your 401k and asset allocation, your banker and broker will tell you that that's the plan. We want to make sure that you don't fall for that. That is not a plan. That's a modern portfolio theory, asset allocation description of what you own and the percentages you've got in different investments. It's not a plan. It doesn't tell you how much income that you can draw for the rest of your life. But because bankers and brokers tell you that that's a plan, and people wonder, geez, I'm looking at this pie chart. I feel like I'm pretty smart, but I have no idea how much money I can draw. Because of that, the number one fear in the United States is running out of money before you die, because people don't know how much money you can pull from that. So Arrin, you just covered a very important point. We're a math-based firm, and when you draw money from laddered principal guaranteed accounts, you can go through some very difficult markets. But when you go through a fluctuating period, you compromise gains when markets go up, you accentuate losses when markets go down. And if you're drawing from fluctuating accounts, it works until it doesn't. And when it doesn't, it's very inconvenient because you have to go to plan B. You have to go back to work, sell the home, move in with the kids. Plan B is never convenient. Arrin, I want to have you cover a couple of things. First of all, talk in contrast of what a distribution plan looks like compared to the pie chart and what the reaction typically is in the first meeting where they get to see the first version of their plan. Invariably, they're happily surprised with the amount of income. So can you cover both of those?
Brian, yeah, I'd be happy to. So this is actually one of my favorite meetings because people really get to understand the difference between what they've been doing for the last 30, 40 years and what their current advisor is telling them to continue to do versus the distribution plans that we put together that really help people have an effective retirement. So one of the things that I really like is just the initial reaction to the plan, that they really haven't seen anything like this before. They're used to just logging into their 401k account, their IRA account, and seeing the asset mix, that pie chart mix of what they're invested in, the stocks and bonds or ETFs or mutual funds or whatever those asset classes are. They really haven't been able to see an actual plan put together yet. And so that's one of the first big differences is that we actually have a plan. It's not just a big bucket of money that we just allocate based off of your risk tolerance and say, good luck, we hope it goes well for you. We want to very much take control of this, help you plan out how much money goes into each specific account, how much income that can provide for you over time. If your focus is more on legacy or charitable giving, there's other ways that we can construct the plan and the portfolio for you. But it very much is a plan. It illustrates how much money goes into these specific accounts, these specific vehicles and strategies. all of the other income sources that you have, we also want to build into this plan. So your rental income, your pension, Social Security, anything else that you have coming in as an income source is also built into this plan. And then we build into the same plan all of the income that you're able to take from the portfolio, from the assets that you've built up, from the 401k account, the other accounts that you've built up. And so we want to make sure that we're including everything that's going to be pertinent to the client's specific financial situation. So it's very detailed. It's very math-based. We want to give you a high level of confidence in the income that we're showing you and the numbers that we're showing you, the projections, the growth rates. All of those things are important to make sure that we aren't missing any of the details that will be helpful in creating a successful plan for you later. So typically what happens is clients will have some kind of an idea about the level of income that they think they can have or what they're hoping to have. And then we come back with the real numbers on our math-based distribution plan. And the high majority of the time, it's higher income-wise than they expected it to be. We typically, while still being conservative, can help them provide more income than they were expecting to have, which is obviously a great thing. So it gives them that confidence that they can have that level of income, that they can do so conservatively, that they're not going to have the fear of running out of money before they die because they're spending too much. So there's a lot of things that it really helps people understand about our approach and what they can have as far as a successful retirement from a financial planning standpoint.
Now, Arrin, those are the people that have already retired, but there's a lot of people that can benefit within 5 years of retirement. We can run the numbers to see when they can retire, and most of the time people can retire sooner than they thought.
Yep, absolutely. Yeah. So we have a lot of people that come to us and say, hey, I'm looking at retiring in the next 1 to 5 years, or hey, I want to retire as soon as I possibly can. Here's the specific income level that I'm trying to hit. When can I do that? And we can help them figure out, okay, based off of your wages, your savings, your income streams, your assets, number of other variables, what point in time or immediately can you hit those specific income goals? And to your point, Brian, 9 times out of 10, it's sooner than they have expected it. I had a client, I don't know, probably 2 or 3 weeks ago come in, or a prospect come in a few weeks ago, and they're like, hey, here's the specific income level I want. I'm expecting to probably have to work another 5 to 7 years to be able to hit this. Tell me what your plan says. We ran all of the numbers, came back, and they were able to hit that income goal within a year and a half instead of the 5 to 7 that they were expecting to. So, and that's not an unusual thing. We have a lot of people that, again, have pretty conservative expectations around when they'll hit certain spending goals, and we help them solidify those. And most of the time, it's going to be earlier than they originally expected, which is awesome. I love seeing the excitement or the, hey, we can retire immediately. It's great to be able to help people make those decisions.
Okay, now let's go into the specifics of the different vehicles that are used.
So great information. I think if you just listen to Brian J. and you listen to Arrin Wray, you get a lot of great information about retirement. The question is, do you know where you are on that road? Do you have enough? Do you not have enough? Are you going to be okay? Will your money last as long as you need it to? That's what the team at Decker Retirement Planning is all about, helping you figure out where you are. You can always give them a call. There's no cost. There's no obligation. They're here to help if they can. 833-707-3030 is the number. Again, no cost, no obligation, no pressure. I think it's one of the more important phone calls you might be making when it concerns your retirement. 833-707-3030, 833-707-3030. We're just getting started with Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. We got a lot more to get to. Stay with us. We're back right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, if you have questions, you have concerns, you can always call the team. There's no cost to do so. 833-707-3030, 833-707-3030. I'm Mark Kelly. Glad you're with us. Brian, back to you. You and Arrin are covering a lot of ground today, as you always do, on Safer Retirement Radio.
Right. We're talking about the difference between accumulation planning and distribution planning. Bankers and brokers are very good at accumulation planning, using the pie chart, buy and hold, asset allocation. But the rules to get you to retirement are different from the rules that you use in retirement. Arrin, you did a great job describing the distribution plan and how we have different income streams. We can do tax planning. We can do income planning. We can do a lot of things with that you can't do with a pie chart in distribution planning that we do. And you covered a lot of that in the last segment. Now we're going to get specific on the types of tools that are used. One of the tools that's frequently used for people's quote unquote safe money are bond funds. Arrin, do you like and use bond funds?
Nope, sure don't. So the reason why we don't use a lot of bond funds or any bond funds in our portfolios here is because of the interest rate and the inflation risk that they pose. So it's one of the things that tends to catch a lot of people off guard, because if you look at what a lot of people have done from a portfolio standpoint, or just the general rhetoric, the articles, the videos in the financial industry, the typical speech is, hey, as you get older or closer to your retirement date, you should put an increasingly larger percentage of your overall portfolio into bonds or bond funds. It's generally viewed as the safer, the conservative portion of the portfolio. So a lot of people will go to a 70-30 or a 60-40 portfolio as they get older and continually increase the portion of the portfolio that's in the bonds or bond funds. Now, the reason we do not do that is because of the relationship between interest rates and the direction, either growth or loss-wise, of bonds and bond funds, where as interest rates rise, as they have dramatically over the last few years, those vehicles, bonds and bond funds, lose money. So the most recent example of this was in 2022. Stocks were down. S&P was down about 19%. NASDAQ down about 33%. Commodities were down. And what people thought was the safer conservative portion of their portfolio, the bonds and bond funds, most of those were also down 20 to 30%, about the same amount as the stock or equity-based portion of the portfolio. Now, that was because of the dramatic spike in interest rates. Basically, ended 2021, 10-year Treasury is about 0.5%. Huge spike up from Fed rates causes the Treasury rates to also increase, and that is a negative thing for bonds and bond funds. So where we are putting together a plan to help you go through the retirement years without having those major drawdowns, those major market corrections in your portfolio, we want to make sure that when we invest your funds in safer conservative vehicles, that they are actually safe and conservative, that you're not at the whims of whatever the Fed decides to do, whatever the market decides to do. We want to make sure that they actually have protection built in so that when you need it, it's going to be there for you to help protect the funds, to help you provide a stable source of income. There's a lot of advantages to properly setting this up. So with our portfolios, where we want to make sure that you can stay retired and not have to worry about your income fluctuating heavily year over year, we don't use bonds and bond funds as the safe portion of the portfolio because of those inherent risks that they have.
We use laddered principal guaranteed accounts, Arrin. So I want to give a contrast and try to paint a picture for our radio audience. The 10-year Treasury yield bottomed in 1940 at 2%. And then for 40 years, it rose to almost 15% in 1980. Peaked out in 1980, nice, neat, and tidy decline for 40 years to 2020. August of 2020, we hit 0.47%. And at that point, when you're so close to zero, I don't understand why the bankers and brokers were continuing to tell people to put their safe money in bond funds, because the upside was so tiny and the downside was absolutely huge. And we were right. Since August of 2020, the 10-year Treasury went from 0.47 to 4.4%, which is where it is right now. And people in the last 3.5 years have lost over about 35% in what they were told is their safe money. That is devastating in retirement. How much of our clients lost in the last 3.5 years on their principal guaranteed accounts?
They haven't lost anything.
That's right. So whether interest rates go up or down, the economies go up or down, the stock market goes up or down, whether China invades Taiwan or not, our clients have priceless peace of mind. Hey, let's run it through the grinder. 2022, Arrin, surely our clients lost money from their laddered principal guaranteed accounts because S&P was down 19, NAS was down 33, bonds were down 20, commodities were down. How did our clients do in 2022?
Mm-hmm. Yep, they actually made money. So that's one of the beautiful things about the vehicles that we're using in the distribution plan that we put together, is that when there's blood in the water, there's still ability to be able to protect the funds and make money. And a lot of people have this just pie chart or passive mentality that they think the direction of the market is automatically the direction, whether gain or loss, that their portfolio is going to have. And that isn't true. And that's one of the fundamental differences between the accumulation strategies that you've taken up until this point in time and the effective strategies that will carry you through retirement. So it's a beautiful thing when we have big market crashes like that, because we don't have our phones here ringing off the hooks. We don't have a bunch of clients calling us saying, hey, what's going on? What are you changing? What are you going to do about this? We've already planned for those things and put into place the vehicles and the strategies that are going to help, regardless of whether we have a phenomenal market for the next 5 or 10 years or a terrible one. And that's the same thing that we do for every client, to make sure that we are not putting your retirement funds at risk. We want to make sure you can stay retired. And that's one of the main ways that we're able to do that.
That's pretty powerful. When the markets are down 400, 500, 600 points, when I was a stockbroker, the phones would ring off the hook. Clients were afraid. What are we going to do? We'd have to talk. I'd have many, many dozens of calls to return. Now markets are down 600, 700, 800 points, and the phones don't ring. That's very true. That's a great point, Arrin. So now let's add another layer to this when it comes to equity strategy. By the way, I want to say this again. This is pretty powerful. In 2022, there were very few firms that made money in the United States. When the S&P was down 19, NASDAQ down 33, bonds down 20, commodities across the board were down, and our clients actually they made money. Most clients made money in 2022. That's pretty powerful. Now let's add the equity portion of the portfolio, Arrin. In a accumulation strategy, it's mostly buy and hold. How do we differ? We differ in quantitative exposure to the markets and the strategies that we use in the markets. Arrin, cover both of those.
Mm-hmm. Yep. So there's a couple of things that we do to both help mitigate risk and help you be able to continue to make money in the markets, because obviously you're going to live for a number of years. You may go through your retirement years for 30 or 40 years. And so you're going to need a portion of your portfolio that is focused on growth. And so the way that we do that is through what's called an actively managed portfolio. So there's a number of different ways this can be constructed, but the advantages are that it gives you the ability to be able to react to what's going on in the market. So in contrast to a passive approach as far as the equity investing, where you allocate the assets to a basket of ETFs, stocks and bonds, whatever the risk tolerance may say, and allow that to ride the movements of the market. In contrast, an actively managed portfolio is something that we are continually buying into and selling out of different asset classes to be able to, number one, provide a high rate of return. Obviously, everybody wants a high growth rate, but number two, be able to provide some downside or volatility protection when markets don't perform very well. Because if you can avoid or mitigate some of those losses, say that the 20% drop year, 30, 40, some of those bigger drops, it means that you don't have to spend the next 1, 2, 5, 7 years digging yourself out of that hole. You're able to compound on that growth, puts you that much further ahead as you're moving forward. And it's able to provide you with some peace of mind around all of those geopolitical things you mentioned, Brian. What if China invades Taiwan? What if the war in Russia and Ukraine continues and kind of spreads around? What if something else happens? Like, there's always going to be things both here at home in the United States and geopolitically that are going to impact markets in some shape or form. And so when those things happen, we want to make sure that the way that we're investing your money, the way that we're managing the money, is able to react to those things. And that's really the power of those actively managed strategies, to be able to both take advantage of the good markets and help protect you in certain forms in the bad markets there.
Hey, Brian, what are you and Arrin going to talk about when we come back?
We're going to talk more specifics about the risk strategy.
All right, so that's coming up right here on Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. And remember, if you have questions, you're not really sure where you are, maybe. Do I have enough? Really, either have enough or you don't have enough. And if you don't have enough, how can you still be able to retire? Well, you better work with a team like Decker Retirement. And if you got more than enough, how do you make sure that you're going to inherit, the heirs you have will inherit the way you want and when you want? There's just a lot of moving parts when it comes to retirement. Brian and the team at Decker Retirement are here to help guide you. Again, that number, 833-707-3030. No cost for this whatsoever. 833-707-3030. And again, if you want to know where you are on that road to retirement, talk with Brian and Arrin and the team at Decker Retirement. 833-707-3030. Back with more with Brian and Arrin. This is Safer Retirement Radio.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Glad you're with us today for Safer Retirement Radio. I'm Mark Elliott here alongside Decker Retirement Planning's team of Brian J. Decker. Brian's the one that started this company. Been in the business since 1986, Brian has. Arrin Wray with us as well. If you want to learn more, it's DeckerRetirementPlanning.com. And don't forget, under the heading of Safer Retirement Education on the website, there are 12 different things you can download, no cost to you whatsoever, including Brian's book on retirement, the Decker Approach book. There's the 3 Principles of Retirement book. There's a checklist challenge. There's a sample income plan. That's just 4 of the 12 things you can download right off the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. No cost to you whatsoever. And if you have questions, you can always call them 833-707-3030. 833-707-3030. Brian, you and Arrin are going to get into a little risk strategies, right?
Right. We're going to talk more about how the markets have changed just recently. You go back 100 years and the S&P 500 is only traded above 30 times trailing earnings 4 times. One was 1929, and it took 17 years to get your money back. The second time was 1964, 18 years to get your money back. The third time was 1999, 14 years to get your money back. Well, the S&P hit 32 times trailing earnings November of 2021. And if history repeats, and it's been 100% accurate, we are looking at 10 to 15 years of a flat market cycle, that means any passive investment strategy, buying and holding stocks, bonds, mutual funds, indexes, ETFs, those will yield a zero net return if history repeats. And history has been 100% on this. Every time we've hit these levels, we've had a flat market cycle. So that's a big difference between distribution strategies where bankers and brokers will tell you to buy and hold. Now, that's devastating in retirement to have your nest egg yield zero over the next 10 to 15 years. By the way, Arrin, you just covered how even in a flat market cycle where markets go up, markets go down, markets go up, markets go down, the principal guaranteed accounts should do well in that environment. Is that true or false?
Correct. Yep, that's right.
Okay, so let's talk about how someone can do well in retirement with an active strategy. So what we've put together, we've done our homework. We went back to look at the biggest study ever done since 1950. What produces the biggest returns in an up market? Jake O'Shaughnessy's book, What Works on Wall Street, page 367, Appendix A, that lets us know that the top performing equity strategies are momentum, also called relative strength and sector rotation. Here's how this works. Every stock is given a relative strength score 0 to 100, and momentum investors own the top relative strength stocks. And there's rotation out of what is dropping and into what is replacing as the higher relative strength stocks. For example, in 2000, 01, and 02, the S&P's down 50%, NASDAQ's down 70%. Well, there were many sectors making money, so the momentum strategies would have had you invested in real estate, gold, silver, energy, pharmaceuticals, biotech, healthcare. All of those stocks made nice returns all 3 years. You wouldn't have taken a 50% hit or a 70% hit like the NASDAQ. You would have made money all 3 years. And then the markets bottomed in March of 03. And what exploded to the upside for the next 4.5 years were small caps, emerging markets, technology, and semiconductors. They made huge gains. And then rolling into 2008, which was a waterfall decline, momentum buys what is going up, and when nothing is going up, you're stopped into cash. But there was one sector that was going up, Treasury bonds. Treasuries were up over 20% in 2008. So you would add a cash portfolio and Treasury bonds. That's how it works. So when the market is trading higher, and by the way, I'm really proud of us, Arrin, we thought outside the box. And when the S&P, when the market's in an uptrend, which by definition is it's trading above the 200-day moving average, when the market's in an uptrend, we have the offense, just like in the NFL, in football, we have the offensive team on the field, 5 momentum strategies that are cherry picking and investing the best parts of the market. When the market turns and starts a downtrend, just like in football, we pull the offensive team off the field and we put the defensive team on the field. The defensive team was handpicked from 2022. In 2022, what did well? Well, S&P was down 19, NAS down 33, bonds down 20, commodities across the board were down with one exception, and that was energy. The frackers, the drillers, the natural gas companies, the crude oil companies, and the pipelines all made 15 to 20%, while everyone else was taking on average a 30% hit. These made money. So we have an offense and defensive strategy, Arrin, available for people in retirement. So there's 2 huge ways that we, by the way, I just want to add a couple things to that. These momentum strategies started in 07, and in all of the down markets since, the defensive strategies we're using have made money. They made money in 08, 2015, 2018, and 2022. Since January 1 of 07, the S&P's average annual return for the offensive side, or for the S&P, is 9.2% average annual return. The managers that we're using are averaging about twice that because we are cherry picking the best parts of the market. Now, in the last 18 months, if you didn't own semiconductors and technology, you've left a lot of money on the table. However, in January 1 of 2022, through Halloween of that year, if you own technology, you lost 30%. Boom, just like that. And you can't do that in retirement. So what we're talking about is how the markets have changed and how Decker Retirement Planning has responded to that with active strategies designed to make money in up markets and down markets. So Arrin, again, to summarize, quantitatively, we shrink our clients' risk from what is recommended from the bankers and brokers, which is a 60 or 70% exposure to all that people have accumulated during their working years. We think that's insane, to more of a 25% portion of their portfolio. So quantitatively, we shrink their risk, and then we strategically lower their risk, having an offensive strategy able to make money in up markets, a lot of money, and make money in down markets. Arrin, what else would you add to risk reduction?
I think you did a great job with the overview there. The only couple of things that I would add are just, again, kind of around the mindset for the shift here as far as the risk mitigation, because I have people on very ends of the spectrum where sometimes we have people come in and they want all the protection that we can possibly build into the plan. And then on the opposite side, we also have people that come in and say, hey, I've been aggressively invested my entire life. I'm comfortable with the volatility of the market. I'm okay with the big swings. If I take a 40% hit, I have the emotional stability to be able to ride that out. And that's great that you do have the ability, that you're not one of those people that sells everything at the bottom and buys back at the top. But you also have to understand that the purpose for the funds has now changed. Again, these are not funds that you have another 20, 30 years to build up, and they're not set aside in a separate bucket if you are already retired and are spending the money. And so even though you may be comfortable with an additional amount in risk, and there is some variability, some flexibility here, but we would never recommend that if you're going to use this money as income over the course of your retirement, we're not going to have you invested in 70, 80, 90, 100% of your portfolio in some type of a stock or equity type investment. It's just not a good idea to do that anymore when you have the funds that you're needing as income and you have a shorter time horizon. So again, a little bit of a mindset shift there, but the big thing to realize here is that when you put into place the allocations that we have on the plan between those principal protected accounts and the risk accounts, we are optimizing for both the protection that you need for income and the amount of risk that's going to help you grow that portfolio optimally so that you can spend that money later in your retirement years. When you're doing distribution planning, this is one of the fundamental differences, is it's not just about growing the number at all costs. So many people are focused on, hey, my net worth or my portfolio went up this year. That was a great year. That isn't the only thing that we're considering anymore. You have to make sure that you're protected. You're using these funds as stable income. And so there's other pieces that come into play that also kind of wrap into that risk portfolio, where you want to make sure to have an appropriate level of risk and an appropriate strategy for the risk funds that you're employing. But again, that's going to be different than what you did 20 years ago when you were 30 or 40 years old. So with the risk portfolio that we have, it's optimally set up both from a percentage of your portfolio standpoint and from an investment strategy standpoint to both help you grow the funds and provide a little bit of risk mitigation when markets don't perform well.
I want to add another piece to the distribution strategy description. The reason clients have more income from their portfolio is because instead of living off interest or gains in the market, which try to do that over your retirement, what do you do when the markets take a hit? We don't recommend that. Try living off interest. How much money can you live on if the 10-year treasury right now is 4.4%? You can get 5% at best, I think, in some of the principal guaranteed accounts. So let's say 5%, you've got $1 million. Can you live on $50,000 a year? Probably not, and you probably don't want to. our clients are getting multiples of that because we are drawing income from laddered principal guaranteed accounts, principal and interest for the first 20 years. And then we use and carve out that 25% of their starting balance. Let's say that they have 1.2 million, 75% comes back to them, principal and interest in the next 20 years. And then the 25% that we carve out in risk with the two-sided strategies designed to make money in up or down markets has 20 years to replace your starting balance of 1.2 million. So our clients are able to draw higher levels of income, have less risk, and get much higher draws from their portfolio because of what I just described in distribution planning.
So when we come back, Brian and Arrin are going to talk about what happens when you call the number 833-707-3030. All right. So is it one meeting? Is it two meetings? Is it three meetings? Everybody's situation is unique. So is every time we sit down with prospective clients, is that unique? We're going to talk about that when we come back. But again, the number, if you'd like to learn more about your specific situation, or Brian and Arrin talking about the opportunity that good markets, bad markets, flat markets, the strategy's got to work regardless of what's happening. You want to learn more about that? It's 833-707-3030. 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker and Arrin Wray right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott again. If you would like to go to the website, DeckerRetirementPlanning.com, you can find out where the offices are. You can find out a lot more information about Brian and the team. You can also find out about upcoming events as well. Plus, you can go to, on that website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. There's 12 different things you could download, including Brian's book on retirement, the Decker Approach book. No cost for you to do that. It's all there for your information. And then maybe you want to call them. You want to learn more about your situation, it's 833-707-3030. No cost for this. 833-707-3030. And I know, Brian, you and Arrin are going to finish up your conversation. Then you're going to talk about what happens when somebody does call 833-707-3030.
Yeah, Arrin, what kind of reaction did clients have when they went through 2022 in retirement, their first big downdraft, and the S&P's down 19, Nas down 33, bonds down 20. Their friends are calling them saying, hey, you know that trip? Well, we really got to put that off. Our portfolio's taking a hit. We got to pull back in retirement. Did any of that happen to your clients?
No, it was awesome to be able to have those conversations, because a lot of the reactions were kind of a mix between surprise and gratitude, where, like you mentioned, most people will talk to other people or just look at the news or the other articles or people around them and see the damage or the drawdown that's happening for a lot of people that just took a traditional approach. And where we were able to provide protection for the funds and growth and not have them take that massive hit, again, it's surprise because they're used to having to take those hits, where if they look at the news and see the S&P or the NASDAQ down, they're expecting their portfolio to be down a similar amount, but also the gratitude that they can have the peace of mind that we've explained to them based off the way that we structure the portfolio and the vehicles there. That again, we want to make sure that you are not having your income fluctuate, whether the market had a great year or a terrible year. We want to give you consistency of that. And so when we're able to do that, actually fulfill the promises that we've made, it's awesome to be able to see how the reaction, the gratitude, the surprise comes across. I love those meetings.
Okay. So Arrin, let's say, like Mark said, someone from the radio show calls in and they want to learn more. Take us through the steps. Now, in contrast, before you answer, I just want to say that most of retirement planning is a two-step process. Meeting one, how much you got. Meeting two, how much can we get? There's no plan. There's no context. As many annuities as we can sell is typically the head-shaking, frustrating response of people who've done these retirement planning calls. Tell us how we're different.
Yeah. So when people call in, again, we want to make sure that the plan is specifically tailored to you. So we go through a number of meetings before we're able to actually finalize everything to kind of get this all kicked off, make sure that you're happy with the structure that's built. And so at the beginning, we really need to do an evaluation. We want to talk to you a little bit more about your situation, both your life situation and your financial situation. Do a review of everything that you have currently, what your expectation is moving forward. It typically takes an entire meeting just to go through all of that stuff, being able to get the understanding of each other. We share a little bit more in detail about our services and how they operate, answer the specific questions that you have, and really get a good fundamental understanding of your situation and what it is that you're looking for. So that's typically the entire first meeting is going through all of those details.
I would add one more thing. I would add the contrast of our strategies to the banker broker strategies.
Mm-hmm. Yep, helping you understand what the difference is. Because like we've mentioned a couple of times on this show, what you have done so far to get you to where you are is not the same thing that you need moving forward. And so we really want you to understand the why behind that, the context of why we're doing what we're doing, because our approach is pretty educational. This is something that you have worked your entire life for, to build up those assets, to get ready for retirement, to flip that switch to stop working and go do the things that you want to do. And you want to make sure that the person or the people that you're trusting to help you with that, you know what's going on, they're trustworthy, you feel comfortable with how we're approaching everything. And so this is definitely not the approach where we just say, hey, ship your money over, trust me, I'll take care of you. We'll see you in 5 years from now if you want to talk to us. Absolutely not the way that we approach this. We want to make sure that you have a very good understanding of what we're doing, why we're doing it, the reasoning behind certain things, the alternatives if you have different goals or want to take a separate approach. We really dig into all of those things to make sure that you feel that we are the best fit for you, that we're trustworthy, that you feel comfortable with the approach that we're taking and how we are building these financial plans. So yes, absolutely, Brian, to your point, there's a lot of detail and information that goes into those first meetings to really help set the foundation for everything else moving forward.
But let's split these out. So that's meeting one. Talk about meeting two. What's covered then?
Yep. So meeting two is typically where you get to see the first version of your income distribution plan. So we walked you through an example, explained some of the mechanics about how those types of financial plans function. But really, at the end of the day, you want to see your numbers. What does that look in my circumstances? How much income can this provide? How much can this provide for my beneficiaries? And so we get into the details around your first version of that income distribution plan. Now, typically, this is a process that is iterative, where that first version is not going to be the final one. We want to walk through what you like, what you don't like, what adjustments you want made, what alternative scenarios you may want to see, and really start to finalize the details of that. We also get into some of the other aspects that we build into these financial plans. So in contrast to what most of our clients have done previously, where the focus was strictly on investments, we also want to build into these plans tax planning, insurance planning, estate planning. There's a number of other aspects that become important and much more so when you're transitioning into retirement versus when your goal is just accumulation. And so as we're putting this plan together that obviously focuses on income, we want to make sure that all of those other puzzle pieces are fitting well together, that it's working as one cohesive unit to make sure that we are not missing anything as we're putting together this plan that's intended to carry you for the rest of your life. So all of those topics, again, income planning, tax planning, insurance planning, estate planning, all of those things come into play as we're looking at this first version of your plan and kind of going through the rest of those details there.
And also in that second meeting, we drilled down on the Social Security optimization report, correct?
Mm-hmm. For clients that aren't currently drawing Social Security, we want to make sure that you're maximizing the value out of that, especially for married couples. There's a lot of different ways and a lot of timing decisions that you have around when and how to draw Social Security. And we want to make sure that we're maximizing that benefit.
Okay, describe meeting 3.
So this is where we get into what we call the stress test. So we want to make sure that we are putting all of the things into place that are going to carry you through retirement. And we've done this for a while. We've seen things that work. We've seen things that don't work, other things that you want to watch out for, little speed bumps or pitfalls along the road in your retirement. We want to make sure that we're planning ahead for those things. So for example, one of the things that we talk through is, hey, one of you is going to pass away eventually. What happens when that occurs? When either the husband or the wife or the spouse passes away, is the surviving spouse going to be okay from a financial standpoint? And if not, if there's some concern around the income at that point, what can we do to head that off or make adjustments now or alterations now so that when that happens down the road, it's not a shock. It's not something that just comes out of left field. You have a plan in place. You have some things ready to go to be able to mitigate or take care of that. So the stress test kind of goes through a number of different things. We hammer that plan from a number of different angles to make sure that we're not missing anything, that we're accounting for all of those kind of the what if scenarios. How do we handle this? And it's a really great way to make sure that you feel comfortable both now and 10 years, 20 years, 30 years down the road based off of the foundation that we're laying at this point in time.
Perfect. You want to handle those now. You don't want to deal with issues in retirement in your early 80s, something like that. Okay, now, so we've got the stress test done. We've got the plan built. We've got iterations that are being agreed upon. What is meeting 4?
Yep. So this is where we get into the details around the principal guaranteed accounts. So we want to help provide you with the overall view of the options for those safe principal guaranteed accounts, and then give our specific recommendations for those individual investment vehicles. So again, these are the vehicles that are intended to provide protection for the funds. They're going to be used as the income source for you, and we still want to maximize the growth or the interest rate that they're receiving while doing points number 1 and 2. So this is the deep dive into all the options for, and then our recommendations for those principal guaranteed accounts.
Okay. And then meeting 5?
This is where we get into the risk discussion. So we want to make sure that you have that portion of your portfolio focused on high growth allocated to the appropriate strategy and recommendation there. And so again, similar to the principal guaranteed account discussion, we want you to understand why we are recommending what we are as far as the allocation for the risk bucket that you have on your plan. So go through all of those details, help you land on a strategy and a method to approach the growth or the high risk portion of your portfolio. And those are the details from the fifth meeting there.
And this is where we build their plan and we see what accounts are transferring in, which ones may not. This is where we build and finalize the plan. Okay, Arrin, tell us quickly what meeting 6 is.
Yep. And then this is where we transition or get everything ready to be able to be moved over. So we've gone through a number of iterations of the plan, gone through all of the details of the plan, and now it's time to be able to go through implementation. So this is us getting ready to be able to move the assets over, get all of those investment vehicles implemented, really starting to kick things off and get that foundational plan put into place.
Considering capital gains and things like that. That's right. Mm-hmm. So hardly a 2-meeting close, right?
Correct. Yep. There's way more information and so many different things we have to review to make sure that we're not missing anything. There's no way I could get that done in just a couple quick meetings.
So again, it's really all about you. How can Brian and Arrin and the team at Decker Retirement help you figure out where you are? Income, investment, taxes, healthcare, long-term care, legacy planning, Social Security, Medicare decisions, safety versus growth. How do you kind of make that balance? And now, how do we go through the emotional part of going from working to now retired? There's a lot of challenges. Brian and the team are here to help. It's 833-707-3030. 833-707-3030. No cost for this chat. There's no pressure. There's no obligation. There's no judgment either. They hopefully can help you, but they don't know. 833-707-3030. Brian and Arrin, appreciate the time. We'll have more Safer Retirement Radio with the team from Decker Retirement Planning next week. Enjoy the rest of the weekend.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.